Imagine waking up one morning, opening your banking app, and everything looks normal. Your balance is there. Your cards haven't declined. No warning, no notification. But when you try to move your money, it doesn't move. Not because the bank failed, not because you did something wrong, because somewhere in the system, a switch quietly flipped, and you were never supposed to notice it. This isn't a story about hackers or scams. It's about how modern money actually works and how it can pause without technically disappearing, and why this matters right now more than most people realize. Here's the uncomfortable truth. Most of the money you think you own is not sitting anywhere, waiting for you. It's flowing, constantly, through pipes you never see, owned by institutions you didn't choose, governed by rules you never agreed to. And when those pipes clog, your money doesn't vanish. It freezes. For decades, we were told a simple story. You earn money, you deposit it. The bank keeps it safe. But that story stopped being accurate a long time ago. Today, money is mostly permission. Permission to move numbers across a network. And permission can be revoked, not dramatically, not publicly, quietly. To understand how this works, we need to zoom out. When you send money, paying rent, buying groceries, transferring savings, your bank doesn't send money the way you send a message. What actually happens is a chain of promises. Your bank promises another bank it will settle later. That bank trusts the promise because of a larger system above both of them. And that system relies on liquidity, the ability to settle instantly if needed. Think of it like restaurants at the end of a night. Nobody pays cash immediately. They keep tabs. At the end, everyone settles up. As long as everyone trusts everyone else, it works. The problem starts when trust wobbles. When markets get stressed, rising interest rates, falling asset prices, sudden losses, banks become cautious. They don't stop operating. They don't announce panic. They simply slow down. Transfers take longer. Limits appear. Temporary holds become common. Nothing is officially frozen. But functionally, it is. This has already happened many times. In 2008, banks didn't all collapse overnight. They hesitated. They stopped lending to each other. Money didn't vanish. It stopped moving. In 2020, global markets seized for days. Even U.S. government bonds, supposedly the safest asset on Earth, couldn't trade properly. The system didn't break. It paused. And here's the part most people miss. The switch isn't at your bank, it's higher. Every bank relies on central clearing systems, settlement networks, overnight lending markets. If those systems tighten, even slightly, everything downstream feels it. Imagine traffic lights across a city all turning yellow at the same time. No crash, no explosion, just hesitation everywhere. Now let's talk about the uncomfortable math. Banks don't keep your money in full. That's not a conspiracy. That's the design. They keep a fraction. The rest is invested, loaned, or parked in assets that assume markets stay liquid. This works beautifully when confidence is high. It works terribly when everyone wants access at once. So regulators built safety valves, withdrawal limits, transfer delays, emergency rules. They're not labeled freeze. They're labeled stability. And here's the irony. These measures often activate before a crisis becomes obvious. By the time headlines scream panic, the system has already been slowing for weeks, quietly protecting itself, not you. This is where hype and reality diverge. We're told modern finance is faster than ever. Instant payments, 24/7 markets, real-time everything. But speed only exists during calm. Under stress, the system reverts to its true nature. Hierarchical, permission-based, selective. Big institutions settle first. Governments get priority. Retail users wait. Not because of malice, because of plumbing. And the bigger the system grows, the more fragile this plumbing becomes. Global finance today is tightly optimized. Minimal slack, maximum efficiency, which means very little room for surprise. A small shock doesn't cause a visible failure. It causes friction. And friction feels like your money hesitating when you need it most. Now zoom out. This isn't just about banks. Payment apps, brokerages, crypto exchanges, all rely on similar settlement layers, different branding, same dependency. When volatility spikes, platforms restrict for your protection. Trades halt, withdrawals queue. Again, no disappearance, just delay. This is why freezes are so unsettling. They don't look like theft. They don't feel illegal. They feel like waiting in a room with no clock. And the scariest part? There's no single switch. It's a series of thresholds. Cross 1, nothing happens. Cross 3, things slow. Cross 5, movement stops. No announcement, no alarm. Just a system choosing stability over access. Which raises an uncomfortable question. In a world where money is mostly digital, mostly intermediated, and mostly conditional, what does ownership really mean? You may legally own your balance, but operationally, you're borrowing access to it. Access that depends on confidence staying intact, and confidence is fragile. The quiet switch doesn't flip during chaos. It flips before, while everything still looks normal. So the next time someone says, "If something was wrong, we'd know," remember this. The most important financial controls don't scream. They whisper. And by the time you hear them, they've already done their job.